Are you wondering whether the Canadian housing market will rise like a phoenix or experience a chill in the coming years? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. According to the latest insights from the Canadian Real Estate Association, or CREA, the Canadian housing market is set to experience a mixed bag in 2025, but a rebound is anticipated in 2026. In 2025, the market might see a slight dip in sales and a modest price adjustment. The projected number of residential properties expected to trade hands across Canada is around 473,090, representing a modest decrease of 1.1% compared to expectations for 2024. This dip is attributed to factors like tariff chaos and economic uncertainty early in 2025, which caused many potential buyers to hesitate. This was particularly impactful in markets like British Columbia and Ontario, known for their higher price points. A slowdown in these major provinces can ripple across the country, even if other regions experience growth. The national average home price is forecasted to decline slightly by 1.4%, bringing it to an estimated $676,705. While this might sound alarming, it's a relatively small shift. The fact that sales activity has been on a steady upward climb since March 2025 is a positive sign, suggesting that the initial hesitation wasn't a rejection, but a delay. Looking ahead to 2026, CREA's projections paint a much rosier picture. National home sales are forecast to rebound significantly with an estimated 509,479 properties trading hands, marking a robust increase of 7.7% from 2025. The national average home price is expected to climb by 3.2% from its 2025 level, reaching approximately $698,622. This rebound is an indication of the underlying health of our housing market. Periods of slight correction or stabilization are often followed by renewed growth, driven by factors like pent-up demand and potentially stabilizing interest rates. The fact that 2026 sales are expected to surpass 2024 levels is a strong indicator of long-term market resilience. Regionally, most provinces are expected to see significant increases in sales activity in 2026. Notably, British Columbia is projected to experience a 12.6% jump in sales, and Ontario a 10.4% increase, indicating a strong return to these previously dampened markets. Provinces like Quebec and Manitoba, showing consistent growth in both sales and prices, might present attractive opportunities for investors. For potential buyers, 2025 might offer a slight reprieve in some pricier markets, creating windows of opportunity. However, with competition expected to heat up by 2026, it's wise to be prepared. For sellers, understanding these trends is vital. A strong rebound anticipated for 2026 suggests that holding on might lead to a better return if you're not in a rush. This forecast is a reminder that timing is everything in real estate. For investors, regional variations are key. Diversification is always a smart strategy, and understanding these projections from CREA is a great starting point for your real estate journey in 2025 and 2026. In the world of commercial real estate, the capitalization rate, often referred to as the cap rate, holds a significant place. Yet, it's one of the most misunderstood numbers investors encounter. According to Volodya Gusak, president of Density Development, a cap rate is a deceptively simple calculation. It's the net operating income divided by the purchase price, representing the annual return on an all-cash purchase, excluding financing costs. While it measures operational performance, it doesn't tell the entire story. A cap rate gives a snapshot of the potential return on investment. But as Gusak points out, it lacks context. For example, if I told you I bought a retail plaza at a 6% cap rate, what would that actually mean? Without understanding the location, tenant credit, lease terms, or building conditions, it's merely a data point. Investors and brokers often treat cap rates like stock tickers, but they reflect much more: risk, market sentiment, asset quality, and income duration. One crucial rule is to use cap rates only on stabilized income. Stabilized net operating income reflects long-term, sustainable performance based on market rents and typical expenses, providing a more accurate valuation. For instance, a retail center with a national tenant like Target might seem stable, but if their lease expires soon and renewal talks are stalled, the assumed cap rate could change drastically. Another important lesson from Gusak is that cap rates are risk-adjusted returns. Think of them as the premium investors demand above the risk-free rate, like the Government of Canada 10-year bond yield, which stood at about 3% in the third quarter of 2025. Real estate typically trades at a spread above bonds, depending on the asset type and associated risk. For example, a grocery-anchored retail property in a metro area might have a cap rate between 5 and 5.75%, reflecting its stability and lower risk. It's essential to verify information rather than just trust it. No two assets are identical. A standalone Tim Hortons with a long-term lease might trade at a low cap rate due to its predictable income. In contrast, an older office tower with high vacancy rates requires significant effort to generate a steady income stream, justifying a higher cap rate. Investors need to be honest about the work required and the risks involved. Finally, Gusak emphasizes that cap rates are snapshots, and the best investors blend numbers with narrative. They delve into the story behind the net operating income, scrutinizing the tenants, lease durations, and necessary property improvements. Mastering cap rates means looking beyond the calculator to understand both the math and the narrative. It's about ensuring the investment aligns with one's financial goals and risk tolerance, ultimately allowing one to sleep soundly at night. Let's turn our attention to Salt Lake City's multifamily housing market, which is facing some significant challenges in the coming years. According to a recent article by Jacob Scholl, the market is experiencing a tough road ahead, with a variety of factors contributing to this situation. The Urban Land Institute Utah's annual Trends Conference highlighted several obstacles that the market is grappling with. Panelists at the conference, including Scott Glassberg, Phil Brearley, Key Padian, Alexandra Schultz, and Kyle Semina, discussed the capital markets and the headwinds facing the multifamily sector in Salt Lake City. One of the key issues is the luxury tower boom that has swept through the city. This development surge has led to an oversupply of high-end units, raising questions about whether renters are willing to pay upwards of $10,000 a month for a unit. The market's current conditions suggest that sales in the multifamily housing sector have significantly slowed down, creating uncertainty for investors and developers alike. Additionally, the lack of new condominium developments stems from concerns over risk and returns. Developers are hesitant to commit to new projects without clear indicators of demand and profitability. This caution is understandable, given the broader economic uncertainties and the potential for shifting market dynamics. Despite these challenges, there are opportunities to be found. Historically, periods of market disruption can lead to creative solutions and strategic investments that yield long-term benefits. For those willing to navigate the complexities, there may be potential for acquiring undervalued assets or repositioning properties to meet evolving demands. While Salt Lake City's multifamily housing market may face years of headwinds, it's important to remember that real estate markets are cyclical. Challenges today can pave the way for opportunities tomorrow, and savvy investors will be watching closely for signs of stabilization and growth. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.